Well, it looks like the Federal Reserve is now warning of a potential short squeeze in commodities just in general, citing a few reasons as to what might spark this. Number one, the positions that are being held. Number two, a lack of liquidity in these markets. Number three, driven by rising interest rates and potentially margin calls. So we are going to dive into exactly how this might happen and how it could impact you. Ready? Let's dive in. And now a quick word from today's video sponsor, Masterworks. During a time period of high inflation, uncertain monetary policy, overpriced real estate, and volatile stock prices, it's more important than ever to consider diversifying across asset classes. Did you know that contemporary art is one of the oldest asset classes in the world? And prices outpaced the S&P 500 total return index by 174% from 1995 through 2020. Not only that, but according to S&P Global, 94% of fund managers could not beat their S&P benchmark index. So how does the average investor have any chance to get better than average returns? Well, you have to look in places that the average investor is not looking. Alternative assets are things like real estate, cryptocurrency, and contemporary art. Blue chip art. Art has been quietly outpacing the returns of stocks over the last couple of decades and has almost doubled the appreciation of real estate, gold, and 90% of cryptocurrencies. Which, by the way, with cryptocurrencies, that's not a hard thing to do since most cryptocurrencies are utter trash. So with this track record, why aren't more people investing in blue chip art? And the main answer is basically price. Most people don't have millions of dollars to go out and buy one Picasso. For this reason, contemporary art investing has been available only to the elites until now. Masterworks is democratizing access to the best pieces of blue chip art in the world, and now you have the chance to get priority access. Masterworks uses over 60,000 data points to find financially attractive art. They then buy them and let you invest in shares representing an investment in that painting. So how are the results? Well, in 2020, they returned 32% to investors, and in 2021, they returned 31% from the sale of two paintings. One of them was a Banksy. And it's because of results like that that over 325,000 people have now signed up for Masterworks. And if you would like priority access and to skip the wait list, I've got a special link in the description below this video just for you. All right, take a look with me here at this article from Bloomberg. The Dallas Fed says that commodity margin calls pose macroeconomic risk because of plunging liquidity. So we need to talk about a couple of things here. So number one, let's talk about what a short squeeze is. If you already know exactly what a short squeeze is and how it works, skip ahead. A short squeeze starts off with a short position. A short position is when I borrow something and then exchange it for something else. So I come to you and I say, hey, you've got an extra iPhone sitting at home on your shelf. Would you let me borrow it? And you say, of course, I'm not using it. It's just a backup. Let's say it's an iPhone 10. So I borrow this iPhone from you. At that moment I've borrowed it. What do I owe you back at this point? I owe you back an iPhone 10. An identical iPhone 10. I owe you that back. I don't owe you dollars. I don't owe you anything but another iPhone to replace what I just borrowed from you. Now I can take that, and in the back of my mind I'm thinking, hey, I know there is a new iPhone coming out in probably 6 months now at this point. And so I'm going to sell this iPhone 10 on eBay and make, let's say, $500 on it. And then when the new one comes out, all the old iPhones will drop in price a little bit. I'll buy another one off of eBay, identical type of phone, identical condition, and I'll give it back. And at that point, since all the prices have dropped, I'm going to buy that iPhone from eBay, let's say, at $400, and I'm going to pocket a nice $100 profit. I'm not going to tell my friend this, but I'm just going to borrow the iPhone. So I borrow the iPhone, sell it on eBay for $500. At that point now, I have entered a short position. I've borrowed the iPhone, so I owe an iPhone back, and I've also exchanged it for something else, in this case, dollars. So I've exchanged it for dollars. Now I have a dollar position worth $500. Now, if let's say Apple tomorrow comes out and says, hey, we are no longer going to be making iPhones. We are shifting now totally towards teddy bears. Well, Apple would probably go under, number one, but number two, all existing iPhones might skyrocket in price because that's, let's say, a collectible item now because there's no more being made. At that point, then, I still owe an iPhone back. I don't owe dollars. I owe an iPhone back because that's what I borrowed. So now I have to go out onto the open market, and I got $500 when I sold it, but now I have to go out and spend $1,000 to go get a new one. So that is how a short position works. You borrow something, you owe that exact same thing back, but in order for you to be short, you can't just borrow it. You also have to then exchange it for something else. And then you have the potential to profit if what you exchanged it for changes in value relative to what you sold. And you also have the risk of loss then. So the next example of what a short position is, because most people are not aware, is buying a house with a mortgage. Technically speaking, you've borrowed dollars, so you owe dollars back, an exact number of dollars, and you use that and you exchange it for a home. So when you buy a home with a mortgage, you are technically shorting dollars. You are buying a home by borrowing dollars. With the iPhone example, you are buying dollars by borrowing an iPhone. You can short a stock by borrowing shares and buying dollars with it. So buying and selling two sides of the exact same coin. In order to short something, you got to borrow it first, then exchange it for something else. And then when you want to give it back, you just have to go relocate it on the open market and pay that item back, pay those shares back, that iPhone back, those dollars back, whatever it was you borrowed. So that is what a short is. So what is a short squeeze? A short squeeze is when there are a lot of people who have the exact same short position, and then they have to close that position out. So let's use the iPhone example. Let's say everybody in America went to their friend and they shorted iPhones by borrowing them, selling them on eBay. Well, at some point then, that position would start to reverse itself. At some point then, somebody would go and buy an iPhone on eBay to pay back the iPhone that they owed. Now, one of those by itself wouldn't move the market, but once everybody starts to have to repay that, now you've got a lot of buying happening of iPhones on eBay, and maybe it soaks up most of the iPhones that are for sale. And so if I still haven't bought an iPhone back in order to repay it, now I've got to go out and try and find an iPhone, and potentially at any price, because let's say my buddy comes to me and says, hey, look, I know you borrowed an iPhone from me. iPhone prices are skyrocketing. I don't want to risk not being able to get my iPhone back, so I'm saying you have to deliver an iPhone back today or tomorrow, or else, things are going to get ugly. So you have to go out, and you might not be able to wait for prices to come back down because he's making a call right now saying, hey, you've got to get it back for me right now. So you've got to go to your aunt, you've got to go to Amazon, you've got to go to Apple, you've got to go somewhere. You've got to pay $1,000, $2,000 because there's just no iPhones available. And the ones that are for sale, they're asking ridiculously high prices for. That is a short squeeze. A short squeeze is when there are so many short positions that once everybody tries to get out of their short position, it's too much buying pressure. It soaks up all the available supply and prices skyrocket as a result. So you might be thinking, well, what does this have to do with commodities? Why would there be such a massive short position, potentially, with any commodities right now? Well, when you think about it, there are a lot of big players out there that are concerned about the prices of commodities going down. So what do you have to do in that case? Well, you've got a hedge. Well, what is a hedge? If you want the price to go up, but you're concerned about it going down, a hedge is a bet on that price going down so that if it does, you at least profit a little bit to make up for what you were losing on the other side. So you've got a lot of hedges out there. This is just one piece, but this is a piece that matters. And a hedge is a bet on that price going down. Well, that's just another way of saying having a short position on that commodity. And as inflation rages and prices continue to move higher, it could very easily spark a run. It could spark margin calls. It could spark a lot of those shorts being closed out and a skyrocketing price of the commodity as a result. We recently saw this take place with nickel. Now keep in mind, nickel is a very illiquid. It's a tiny little market. You probably wouldn't see similar moves happen in gold, in silver, in some of these larger, deeper markets that are much bigger, much larger market cap. They're just, it's harder to move them as much as it is something like nickel. But the risk exists nonetheless. And finally, the other thing that could spark this is margin calls, is tightening liquidity. If we take a look at interest rates have obviously been moving up recently. The federal funds rate is going up. All other interest rates are going up in anticipation of the Fed funds rate going up even more, and that is leading to margin rates going up. Margin rates is that is the rate that people pay to borrow dollars in order to trade commodities, stocks, things like that. And so if there are any large positions out there that are really close, if their position starts to lose, they get a margin call if their position starts to lose too much. And as interest rates go up, that gets you closer and closer and closer to the edge because the amount of money you have to pay to maintain that position starts to increase. So as interest rates go up, liquidity dries up, which puts traders and puts people who have short positions in more and more precarious positions where they may have to close that out. They may get margin called. And if this starts to happen all at once, it can lead to a cascading effect where me closing out my position makes the price move, which makes you have to close out your position, which makes the price move even more, and down and down and down the line it goes until you get a nickel type situation where the price just goes up and up and up until they decide, hey, we're just going to stop trading. And then everybody blames capitalism and free markets. At the end of the day, these are mechanics that always end up crashing markets or at least causing great volatility for all of human history, even the Great Depression. You had a massive levering up at extremely low interest rates. As soon as interest rates started to rise, you started to have margin calls take place, which prompted selling, which prompted even further drops in the prices of those assets that were bought with debt, which caused even further selling as more margin calls came in, and down and down and down the line it went. So the likelihood that we experience more volatility, less liquidity, and shocks in the global financial system around the world are getting higher and higher by the day. That's what happens when you have an economy built on debt, built on fake money, and then you have a rapid expansion of that debt and that fake money. And then you have the central policymakers start to pull the rug out from under the economy and tighten, increase interest rates, and make money harder to get. You are bound to have at the very least volatility and at the worst, unstoppable crashes. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.